In today's episode of the Daily Brief, I'll talk about two big stories. I first talk about the new way companies might be trying to scam investors. I then discuss how a revolutionary change is going to sweep the healthcare industry in India. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that is one level deeper as compared to other news channels. I'm your host Kashish Kapoor. Today is Thursday, 5th of December. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the show notes. Starting with the first story. The stock market is a place full of contradictions. On one hand, the Indian stock market grows stronger every year, helping more people achieve their financial goals. But on the other hand, it's also a place where a lot of folks lose big money. And not just because of bad investments, but actually to scams. We have seen it all, from pyramid schemes promising double your money returns every week, like the one that blew up in Assam recently, to scammers impersonating brands to trick people. Sadly, we've seen this happen to some of our own clients at Zerodha too. Today, we want to tell you about two more scams that you should know about. Let's start with the first one. Imagine this. A company launched an IPO to raise money, claiming they'd use the funds to buy some fancy software. But the catch is that the software was supposed to come from a third-party vendor, which, as it turns out, was a shell company. This so-called vendor had zero ability to actually build or deliver the software they'd promised. And the sad but funny part is that investors didn't just buy into this IPO. They oversubscribed it by 345 times. So exactly what happened? Let us take it from the top. On May 31st, 2024, a company called Traffic Soul ITS Technologies filed for an IPO. They're in the business of making intelligent transportation systems. Think traffic automation, toll management, etc. They plan to raise about 45 crores, with 40% of it, that's 17.7 crores, earmarked for buying a software called Integrated Command Control Center Software, that's ICCC. This software is a crucial piece of technology for running smart cities and is typically imported from international vendors because Indian technology ecosystem is simply not advanced to deliver something like this. Fast forward to the subscription period between September 10 and 12. Investors went wild. Against the 45 crores that the company wanted, they poured in 10,000 crores. But not everyone joined the herd. On September 16, just a day before the shares were supposed to get listed, a complaint landed in the box of Sebi and BSE. The complaint flagged something fishy about the third-party vendor supplying this so-called software. Sebi put the listing on hold and started digging. Investigation started, which lasted a couple of months. Sebi sniffed around, issued show-cause notices, and pieced together what was happening. On December 3rd, they finally issued an order confirming that the vendor was indeed a shell company. The software vendor couldn't build the promised software. Now the big question is, was this a deliberate attempt by the company to siphon off IPO funds? As of now, Sebi has ordered the company to return the funds to investors along with the interest it earned while locked up. The IPO and the shares will be cancelled. But what Sebi uncovered and how they figured it out, that's some straight-up spy movie material worthy of its own Netflix series. Here are three big problems Sebi uncovered during the investigation. First, no operational capability. When Sebi checked the vendor's office, they found it locked and empty, showing that no business was actually happening there. On top of that, the vendor didn't have the skills or tools needed to create the software. This made it clear they couldn't deliver what they had promised. Number 2, fabricated financials and bogus client list. Sebi discovered that the vendor's financial documents for all 3 previous financial years were created on the same day, suggesting they were fake. Additionally, the client list submitted as a proof of credibility was bogus too. 2 of the 3 mentioned companies had never conducted business with this vendor. These findings highlighted that the vendor existed only on paper. And number 3, suspicious vendor selection process. The vendor and the company were introduced by a middleman with no open process to invite tenders or evaluate multiple vendors. The code for this software was given before they had even met, and they only met after Sebi got involved. This suggests that the code was likely fake and used to make the transaction look legitimate, pointing to a possible attempt to misuse the IPO funds. For now, the company is still off the rails. While the vendor has been exposed as a shell company, the bigger questions remain unanswered. Was this all a deliberate attempt to embezzle funds? Was there no background check done before getting a quote from the vendor? Or did the company know everything all along? Was this orchestrated by the company itself and they are now denying it? What about the merchant banker? Did they fail in their duty to conduct due diligence? And what about the CA who signed off on all those suspicious financial statements? Were they complicit too? Too many questions, but one thing is clear. SME IPOs, with all their buzz, have become a breeding ground for shady activities. This case is just another in a string of issues that have surfaced, and it's likely not the last. For context, SME IPOs have already raised 6,300 crores in FY25 till November, suggesting there might be more skeletons waiting to be uncovered. Now, if you thought the SME IPO scams are wild, let me tell you about another shady story that Sebi cracked wide open. This one's about a man known as Bap of Charts, a popular financial influencer who promised his followers sky-high stock market returns. It already smells suspicious to us. And if that isn't enough, check out the entry of this guy in one of his masterclass workshops. Well, he's definitely good at making grad entries, but not so good at scamming people. Because Sebi's investigation revealed that he wasn't just giving free advice out of the goodness of his heart. He was running an unauthorized investment advisory service, collecting crores from unsuspecting investors. Here's how it worked. Under the guise of offering educational courses on stock market trading, he and his teams provided direct buy and sell recommendation to their clients. They weren't ordinary classes. They were packaged with promises of guaranteed returns, pulling in innocent investors who wanted to strike gold in the markets. Over time, he and his 6 associates managed to rake in 17.2 crores in fee. And you know the funny part, this self-proclaimed stock market guru wasn't even profitable in his own trading. Sebi found that he concealed his trading losses while promising extraordinary returns to his own clients. His flashy YouTube videos, social media posts were all part of the act to reel in more people. Sebi wasn't having any of it. After months of investigations, they banned him from the securities market for a year, with his associates getting 6-month bans. On top of that, they've been ordered to refund the 17.2 crores to their clients plus some penalties. The lesson here, if someone promises guaranteed stock market returns, run the other way. As Sebi tightens its grip on these so-called financial influencers, it's a reminder to always verify credentials and think twice before following the hype. Because when it comes to money, there's no such thing as a shortcut. In the next story, we are diving into what might be the biggest disruption in the healthcare and consumer behavior we've seen in decades. Earlier this year, Morgan Stanley projected that the global market for obesity drugs like Ozempic could hit $105 billion by 2030. That's a 15-fold increase from today's $6 billion market. This is much bigger than just a weight loss story. Let me paint you a picture of why this matters, especially here in India. According to a study published in the Lancet journal, we are facing a significant crisis. 40% of Indian women and 12% of Indian men are dealing with abdominal obesity. In our urban areas, these numbers are even more striking. Nearly half of urban women face this issue. What's particularly concerning is how this varies by age. For women between 30 to 39 years old, about 49.3% have obesity, and this jumps to 56.7% for women aged 40 to 49. Now, these drugs like Wegovy, Mounjaro, etc. were originally developed for diabetes, but researchers started noticing some remarkable and unexpected effects. 2 groundbreaking studies have everyone talking. The first, from December 2023, looked at over 5 lakh patients with opioid use disorder and more than 8 lakh with alcohol use disorder. The findings were stunning. People taking these drugs had over 40% lower rate of opioid overdose and 50% lower rate of alcohol intoxication. Then last month, an even more detailed study published in JAMA added fascinating depth to these very findings. Looking at over 14,000 people in weight management program, they discovered that nearly half of those who were drinking alcohol when they started these medications naturally reduced their consumption. What's particularly interesting is that this wasn't just a small change. The reduction was significant enough to potentially have major health implications. And here's the key part. These people weren't trying to drink less. It just happened naturally, suggesting these medications might be fundamentally changing how our brain responds to certain substances. But it's what Morgan Stanley's research is showing about food that's really catching attention. These drugs are completely rewiring people's relationship with food, particularly processed foods. Their surveys found that people on these medications are not only eating less overall, but half of them have drastically cut their consumption of sugary drinks, alcohol, and snack foods. Nearly a quarter stopped drinking alcohol completely. The food industry is watching this with growing concern. The New York Times recently reported that major food companies are panicking because people on these medications are losing their taste for ultra-processed foods. And this timing is particularly crucial for India, where our urban areas are seeing a major shift towards processed foods. In our wealthiest urban households, nearly 30% of daily calories now come from processed foods, and states like Kerala and Tamil Nadu are seeing obesity rates as high as 65% and 58% respectively. Food companies are scrambling to adapt. Morgan Stanley predicts that up to 9% of the US population potentially will start taking these drugs by 2035. Companies will need to fundamentally rethink their products. They're already developing smaller portions and healthier options. But there's an unexpected upside too. Their research shows that people who start these medications are twice as likely to exercise regularly, potentially boosting industries from fitness equipment to athleisure wear. This isn't just about weight loss anymore. Morgan Stanley's recent analysis shows these drugs could help prevent more than 200 chronic diseases, from diabetes to heart diseases. One clinical trial found a 73% reduction in diabetes risk and 20% drop in cardiovascular events. We're talking about a treatment that could potentially add up to 10 years to your life expectancy. Now, this revolutionary class of drugs is about to see major developments in India. According to Reuters, Novo Nordisk, the Danish company behind Wegovy, is planning to introduce it here by 2026. But there's interesting competition brewing. Their Indian team is pushing for an earlier 2025 launch to avoid falling behind another company, Eli Lilly, which plans to bring its weight loss drug Mounjaro to India next year. But here's where it gets even more interesting for the Indian market. Our homegrown pharmaceutical giants aren't sitting idle. Companies like Dr. Reddy's, Biocon, and Sun Pharma are already gearing up to manufacture more affordable versions of these drugs once the patents start expiring. Dr. Reddy's in particular has been investing heavily in infrastructure to be ready for an immediate launch when the main patent expires in 2026. This timing couldn't be more crucial when we look at India's obesity crisis. The Lancet study shows that in our urban areas, nearly half of women face obesity, and the numbers are rising up in rural areas too. Indian doctors are already reporting huge interest. As one of Mumbai physician told Reuters, every patient is asking about these weight loss injections. Now on to the tidbits for the day. First, the Lok Sabha passed a bill amending 5 banking laws to enhance governance and depositor protection. Key changes include raising the substantial interest threshold for directorships, standardizing reporting timelines, and allowing up to 4 nominees per account. Second, South Korean president's martial law decree faced unanimous parliamentary rejection, forcing a swift reversal. The political fallout has deepened his unpopularity, destabilizing South Korea's democracy and economy amid public outcry. Third, India saw 92,000 patent applications in FY24, reflecting a booming innovation culture across technology and pharma. Strengthened IP policies are fostering investor confidence, job creation, and positioning India as a global research hub. And for the last one, the RBI intervened with $2 billion in the forex market as rupee touched 84.76 per dollar. Despite stabilizing at 84.68, concerns remain over further depreciation as forex reserves continue to decline under global currency pressures. And that's it for today. I'm your host Kashish Kapoor. This was the Daily Brief, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.